everyone's worried about our national debt, how we make short-term decisions and we pay for it in the long term, and it's like Trump, comes in and says like, hey, we're going to do things different, and he's done a lot of things different. But then they toss out stuff like this, and it's like this is the same stuff. Well, this is not.
In this episode, the speakers discuss annuities. Any guarantees apply only to contractual obligations of the issuing insurance company.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt here with Isaac.
Hello.
Almost called you Eli, and John.
Morning.
Hope you guys are doing well. We are, is this second episode of 26 or third?
Wow.
Yeah, it's crazy. Second episode of 2026. So
only 48 more to go.
Yeah. So yeah, it's January will be over before we know it, which is wild. But today we're going to talk about a couple things going on in the market and the economy. But we're going to start with a question like we often do. Remember, if you haven't liked, subscribed, if you don't comment, we encourage you to do so. We love looking at those and appreciate you guys following us. Shoot us an email if you have any questions. Actually, don't do that. I just learned our email has been down. So it's fixed. Okay, so Zoe, our producer, said it's fixed. So send us an email. It's up and working again. So anyway, quick question that we wanted to start with today, which is good. Now this, let me kind of preface it with, there are so many different rabbit holes we could go down right here. So we're not going to cover everything, just a handful of ideas or ways that this can be done. So the question is, how do I produce income from my investments? So if we're trying to live off of it, trying to produce income from the assets that we have, the investments we have, what are ways to do that, and the good and the bad and things to be aware of? Yeah. Again, these are just some of the options. So let's start with products. So when we say investments, there are specific products that are specifically designed to generate income, right? They do other things not very well, but they potentially produce income very well. And so, John, what are a couple? There's quite a few out there, but what are a couple of specific products that generate
income? Annuities come to mind, but I know Isaac is a little more. He's kind of on top of this stuff pretty good, but yeah, income annuities where basically you give your money and you're specifically trying to get the highest income rate you can get, which a lot of these products can give very good interest rates. The negatives, of course, are, and I always tell clients if they choose that path, once they put that money in, it's gone forever. It's kind of what I tell them.
Yeah, it's like a pension. You're creating your own pension. You're giving up the potential asset growth for the higher income that it's producing.
Yeah, and we've seen over the last several years the income benefit numbers are pretty darn good. I mean, I started my career, and I'm not kidding. We had a company that gave 5% for life was their income guarantee, and it was the highest on the market at the time. Yeah, this is 25 years ago, and that was good. That was considered good, and people like that. And of course, nowadays you can get much higher. You can get quite a bit higher. Isaac, I mean, you can get a little better than that.
I mean, there's statistics. They're all put out by annuities companies, so I don't know which ones are true. But it's like it'll say, retirees who have guaranteed income in retirement end up spending twice as much as those who don't because they're not in fear of making their assets last. And I think there's probably some truth behind that.
Yeah.
There's
income's coming in.
Income's coming
for
in.
Life.
You don't have to worry about it. I like to say, it puts less of a strain on the investments to have to perform because where stuff's coming from. Not to turn this into a annuity sales webinar.
Yeah.
But there's a lot of benefits to it. On the downside, like you were saying, they're a horrible product if you want to leave something to kids.
Yeah.
Because the purpose of it is you're going to give this money, they're going to send you monthly income, and if there's something left over, great, but probably not.
You got to make sure you have plenty of liquidity outside of it because you don't want to try to dip into that for liquidity needs. So that's the income annuity side. There's now I'm just going to kind of shotgun style start mentioning a few options. One thing that's really blown up in the last few years in the product space, if you consider ETF products, the covered call ETF world, it's completely blown up. There's some really, really bad, really bad ETFs out there that show crazy high dividend yield or crazy high yields. But I'm just throwing all the things out there. I'm not saying they're all bad. There are some better ones out there that if you're trying to produce a higher yield, higher level of income, there's some covered call strategies, whether it be ETFs or you're doing it in an SMA, but you're using options, selling options to produce higher income. But just like the annuities, there's downsides, right? A lot of these ETFs have horrible total return performance. A lot of the income, is in a lot of ways just kind of a return of your principal.
Yeah.
And how they're showing that really high yield. But it's something to consider. We've used some of those in the past, and it's not that they're all bad. Just definitely know what you're getting yourself into. Just like the annuity, know what you're getting yourself into if you're trying.
Well,
to
and it's hard. I'm going to tell you something. I have a real. I know you're going to shotgun approach, and I'm ruining that for you.
No, you're good. Go for it.
So, but I have an example of a client that called me one time, and a reputable investment magazine. I won't say the name of it, but reputable investment magazine. He had read an article. There's 3 different ETFs that you must own in retirement for income, right? Must own. And he gave me the symbols, and I researched them, and I didn't necessarily like them that much, and I didn't, it was, again, like those, what you're talking about. We bought them. They are basically went half of the value. So if you bought them for $10 a share, they went down to $5 a share within like a year. Now, the yield was fantastic, but you lost half of your money that you put in, right? So to your point,
you got to be careful.
Yeah, it's a reputable magazine. Said all this
sticker
stuff
price on like, hey, if it's like, hey, this is producing 15-20% payout. It's like, the old adage, if it sounds too good to be true, it probably is.
Most of the time it is.
It probably is.
Yeah.
So you have covered call strategies. You have kind of your more traditional approach of like buying dividend-paying stocks.
Yeah.
Right? Buy some companies that produce a good dividend. It's, in a perfect world, that's not a horrible way to do it. If you can find a good dividend-paying company, you have opportunities for continued, growth and appreciation in the position itself while it continues to spit off income. Downsides, there's pros and cons. There's ways that can go bad. Just
dividends
like
can be cut, stock can get hurt. Yeah, on and on.
You can invest in interest-bearing positions. You can which is going to get tougher as interest rates start to come back down. But there's all kinds of ways that you can produce income. You can go buy real estate, right? Buy cash flowing assets to, hey, I'm going to take this capital and buy an asset that's going to spit off income. And real estate can be a great way to do that. So there's no right or wrong way. Typically, if you're trying to, especially let's say you're a retiree, near retiree, if we can have income, like, I always hesitate to say guaranteed, but if you can have steady, stable, predictable income coming from multiple places, 2, 3, 4 different places, whether it's Social Security, real estate, income annuity, dividend portfolio, whatever it is, and you're not overly dependent on one source, you're generally speaking, that's a pretty good spot to be.
Yeah. And we talked about this a little bit before we started, but dividend are taxed at ordinary income rates. And so if you're in a high income tax bracket in retirement, it might make sense to find some sort of stock that doesn't spit off a huge dividend, right? And try and sell some stocks to be in those capital gains rates.
Right. Yeah, capital gains rate could be much lower than the dividend rate that you'd be paying.
So maybe you're selling and you're filling up a bucket of cash, and that's what you're living off of.
Or just know the dividends what kind of dividends that qualified dividends can be taxed at the lower capital gains, but ordinary dividends, are taxed at your ordinary income. And you're exactly right. Like some people get so fixated on, I want dividends. I like the idea of like, this is going to send me a check every month or every quarter, but depending on your tax situation, you might be better off just investing, letting the whatever you own appreciate, realizing a gain, especially if you can hold that. If you can hold it for more than 365 days and be in the long-term capital gains bracket.
We saw that a lot here in the past couple of years with interest rates being so high. I mean, a lot of people that I've met with were just taking advantage of their savings account, paying 5%.
Their interest income is a lot higher.
And so they're thinking they're doing the right thing, and for them, they probably were. Just taking that, guaranteed from the bank interest rate. And instead, they could have deferred into something that was capital gains in a lower tax bracket. And so making sure you're minimizing your tax.
There's a lot of things that go to take into consideration, right, when you're starting to look at how is this taxed.
Best part about all this conversation is that if you have an advisor, if you have a planner, all of this stuff can be on the table, and you can find out the best solution for your situation. depending on your tax bracket, depending on how you want to invest, your risk tolerance. I mean, everything is considered. And you can, like you said, you can build a diversified portfolio, which is really smart, of different ways to get income. But you also can protect yourself from taking too much risk. Like I think, and to your point, the person that gave me that list that got from a reputable magazine that said this is what you need in income, he would not have bought those. He would not, and I did not want to buy those, by the way. But the point is, we bought them outside of our normal planning, and they went down in half. Had you known that, you wouldn't have done that, right? So a lot of times, if you can actually sit down and sometimes we just take orders from clients, but for the most part, when we plan properly, you could build out a really nice portfolio and let us help you do that.
Well, I'm going to try not to go on a tangent here, but whether you're thinking about how to solve for income or anything else, I think always starting with and accepting the fact that there are ways that this, whatever you're considering, every option has a scenario that it doesn't go well.
Yeah.
And like being true and honest with yourself about how does this, because everybody's going to talk about all the ways it's going to go right.
Right.
Yeah.
Right. Whether it's your advisor, your friend, your buddy, whoever.
Yeah.
But it's like everything has this, every option out there has the scenario of like, what does this look like if it doesn't go well? Maybe it may not be catastrophic, but it's just like, what is kind of the worst potential outcome?
And you might start with that.
Yeah,
Always start
both
with
sides
that.
of the coin, because
I agree.
Because a lot of people get fixated on or have the expectation of like, well, this has done well for the last 5 years, or this has gone well, so that means it's going to continue to do well. And so you just have to know what you're getting into, because every option we listed has some really good upside, really good benefits, the reasons that you would do it, and then every one of them has reasons that you wouldn't, and that you should, reasons that a lot of people might need to stay away from that particular option. So just, take everything into consideration. So anything else on, producing income from your investments? We kind of kept it pretty high level there. Yeah. But anything else you guys want to mention?
No. Again, I think it's about planning.
Yeah,
absolutely.
Okay, so 2 points we want to touch on real quick. So we got the updated inflation number this morning, 2.6%, less than expected. Market's kind of muted. Dow's down, Nasdaq's, Russell's up slightly. Any thoughts on? I feel like this has kind of been the trend. Like the inflation numbers have been coming in at or slightly better than what we've been expecting.
Yeah, I mean, I think things are. Here's my, things are fine. They've slowed down. Everything seems to be, doing better, right? Yeah. We went through that period of really bad inflation, and now things have gotten back to kind of normal
in terms of the rate of
of acceleration. We're still not. It still hasn't gone down enough to make up for what we went up so much, right?
And it's not going to.
It's not going to. Yeah, we're kind of in a new normal, if you will.
Sure.
Although some things are coming down, like gas prices across the country have come down quite nicely. Some other stuff, consumer. I mean, I think groceries prices have gone down. There are certain areas where things are starting to hit Main Street, which is good, right? They're starting to feel that. So these are good numbers. Nothing to report. Like, I'm glad it came in.
Yeah, it just good to not have a surprise.
Yeah, it's good not to have a surprise.
No news, good news.
Yeah, exactly.
So we'll see. With the Fed and what they're doing, that's a big.
We could have a 6-hour show on the Fed, but that would. We wouldn't have anybody watching or listening.
There's a lot going on the Fed right now. Pal's running for cover. But it'll be a lot, like it has been the last couple of years, a lot of what the market does this year will be based on, Fed, what they do, how poorly or well they manage that. So hopefully inflation can stay under control and they can do their job.
Right.
And then the other point we were going to talk about was I completely forgot.
The interest rate cap.
Oh, yeah, the credit card interest rate cap. So Trump put out this tweet or whatever platform he was on the other day and said, hey, we're going to do a 10% cap. And then I saw later on it was like, well, this is just going to be for a year. I don't know if that came out at the same time or not, but I think the latest has been we're going to do a 1 year 10% cap on credit card interest rate. Okay? Mm-hmm. So thoughts?
At first glance, I like the idea of it.
Yeah, I mean, it's hard not to like
it immediately.
The headline.
And then like we do in this industry, we start thinking of all the ways it could go poorly. I think of all the times that, if I was like, I've got some real estate investments, and sometimes when you're investing in real estate, you don't get prime interest rates. So sometimes I got to go use the lowest credit card to fix up a house. And if they were offering me a 10% cap on that, probably would have bought a lot more stuff. It's like it honestly might encourage even more overspending, right? You see a lot of this, like you get used to the new normal. Happened with the tax credits for health insurance. Like you get used to this new normal, and it gets taken away, and you're like, whoa, what's going on?
Yeah,
it's like, well, this was not permanent.
Yeah, it was never supposed to be permanent, but people have gotten used to it.
Okay, so my thought on it, I look at our debt crisis that we don't really talk about that much, but we have the largest credit card debt we've ever had in our history of our country. And this is why, now it goes back to spending, because we had the spending habits when COVID happened and we got checks for nothing, and the spending kept going on from non-productive work, right, which was unusual, and that's why the M2 measure of money supply went up and all that stuff. We go way into the weeds on that. But people want to spend, they want to continue to spend until they're capped out, and credit cards were the way to do that, right? Continue to go travel, to continue to buy stuff, even if you don't have the means to do it. It's almost like an undisciplined way to live your life, right? And so there's a lot of people affected. I, on the surface, do like this. I do agree with you on some of the things that could go wrong. Yeah. If people were disciplined, this would be great.
Great.
It's just that it might create some, like you said, some more further debt buildup.
Yeah, there will be a select few, and hopefully the majority, that uses the opportunity to pay down the balance.
Yeah, to get
right?
things in order.
This is a huge opportunity to catch up.
But most of our clients, I talk most of our clients that we know that are diligent with their money, right? They use credit cards to, they use them, they pay them off every month. They use them, pay them off. This doesn't matter to the majority of those types of people. It doesn't matter. But it's the folks, and I do think it helps the middle class and under that sometimes have to use credit cards as a last resort for groceries and so on. Yeah, I hate that they have to pay 28% interest on groceries.
So here's
that's my
here's all the ways it goes bad.
Okay, talk to me.
Is one, are you going to force credit cards? Companies extending credit to consumers to still offer the same amount of credit that they were offering previous to this, because they probably won't.
Yeah, they probably won't.
They can't. I mean, it's just
yeah.
You can't say you do this and then all the businesses are going to be like, well, we're going to lose a ton of money, and a lot of people are going to default because they aren't qualified to borrow at 10%, but we're going to give it to them anyways.
Yeah, right.
Like that's probably not going to happen. So people that have credit card debt, it's helpful for a year because it's like, hey, we have a year of less debt, of less interest that we have to pay. But people that need credit, like new credit or more credit, I think
it could hurt them.
It could hurt them very bad. I mean, I think it would actually, we would see a decrease in spending overall because of that, because people wouldn't have access to the credit they need. And then the other side of it is like, okay, what happens after the fact? Let's say all this, nothing blows up. Credit is extended. People can get the credit they need. And it's just, the headline is the scenario. 10% interest rate
for
cap
1
on
year.
Credit cards. People still can get access to capital. Well, what are the credit card companies going to do after that 1 year?
Yeah.
Like they're just saying, hey, we're going to cut our profits in half for 12 months,
and then we're
not going to have to try to claw some of that back after the fact.
They're going to bounce them back.
Like maybe rates are at 23%. You don't think they're going to be at 28, 29 after the 12 months? So like I think the headline sounds great. When I first saw this, I was like, man, that would be sweet for a lot of people.
Yeah.
But then you really start digging into like the residual effects of the trickle down, what would happen, what wouldn't happen. And I think it's more negative than positive.
So I'm hopeful that it would be positive, but I totally get what you're saying.
It feels like shooting up steroids,
Yeah.
It's like it's the short-term effect, can be great, but it's just like if you don't then continue it or then it's just like it can just balloon something and make it a bigger issue in the future.
I agree. The conversation is good though, because there are sometimes I think the credit card, I mean, they've gone it's gotten so high that, you wonder, and I don't know the ins and outs of this. I know Visa's numbers when they come out and so on, and you can kind of tell, but goes back to that greed conversation, and I'm a capitalist, whatever, but you get my point. Like, is there a point where the credit cards get out of control? So I do think there needs to be a cap. Now, maybe it's not 10%, but You ever had those interest rates, you go get furniture or something, it's 0% for 12 months. That only works if you pay it off in that 12 months.
Yeah, because then they just
hammer you. It's like 30%, 32% on that 12th month, and it's on all of it, right?
Yeah.
So folks that get trapped in that and they think it's great, and this is the same thing that can happen here on the other side of that. If they give credit, people could really go out and use it and then get hammered on that 12th month in one day because the credit cards will go right back to what they were.
It's not a solution.
Yeah.
It's a very short-term Band-Aid.
So if I shoot you in the arm and you're bleeding,
that I'm afraid would have longer-term implications.
And I give you morphine and I put a Band-Aid on it, that's what you're talking about. It doesn't fix anything. It makes you feel good, but it doesn't fix anything, right?
Yeah.
That's a really
and
bad
in 12
analogy,
months, he's going to be ticked at you.
Exactly.
Yeah.
But that might be what it is like.
Yeah. It is a hard balance between, it's like government stay out of the way.
I know.
Because it's like what should they, can they control and regulate? But, credit, having access to credit is not, I don't know. I don't want to have like a hot take, but like having access to credit
I think you should do your hot take.
It's not a fundamental right.
No, it's not.
As a human being.
Yeah.
Right?
Yeah.
It's like we've become used to it being readily available in our society. It's not around the world.
It's not around the world. We're unique.
We've been very used to. So it's like, I just think the more we treat it like this fundamental right that everyone should have at the same level, I get it. And in a perfect world, like that's what I would love to be true. But everyone's worried about our national debt and how we make short-term decisions and we pay for it in the long term. And it's like Trump, comes in and says like, hey, we're going to do things different. And he's done a lot of things different. But then they toss out stuff like this. And it's like, this is the same stuff.
Well,
that
this is not
does.
much different than student loan debt payoff, right?
Yeah.
Where you don't have to pay your student loans off. At least it's kind of like sounds euphoric and wonderful for those affected. It sounds great, but it affects so many other things negatively. Like, for example, I paid my student loans off at a high rate of percentage. And the fact that somebody can go out and get $100,000 in student loan debt and then not have to pay it off kind of makes me mad. But, that's the point, right? I mean, it's like to your point of you have to earn things. It's not like a free. We've gotten to where we're used to just things being easy, made easy, free, whatever. We could go on a tangent on this forever. And I agree with you on where you're going with that.
I hope they really think long and hard before they actually make any final decision. But it was an interesting headline nonetheless. And obviously was worth talking through this morning. So
it's just pros and cons of everything. It's like
everything.
Yeah.
in a perfect world, sorry, this whole new topic, but this is the problem with federal policy at the federal level. Like you're trying to help people. And I think everyone out there, it's like everyone wants the people who need help to get the help they need.
Yeah.
But how you create federal policy at the national level that does that doesn't also get taken advantage of by a lot of people, that doesn't have negative repercussions for others down the road, like that's really hard. That's why more of these decisions need to be made, at the most local level possible. Like I wish our city council and mayors were making most of these decisions because then you could go directly to the source of who needs the help and how can we help them. Make it to the federal level. There's so much corruption, fraud, and stuff that goes on.
Look at the fraud stories right now. The fraud stories, and I think we're at the tip of the iceberg on the fraud stories. Like I think there's so much more to be uncovered from the federal level, not just the state of Minnesota that's being kind of attacked right now, which is rightfully so, but I think that is spreading. That's going to spread. I think you can find that every level. And the more you have big government intervention, the more opportunities and layers there are of corruption and abuse and whatever of that.
Yeah. So we'll see. We'll see. January 20th was Trump's deadline. So we'll see what happens next week. Yeah. Well, as always, we kind of got a little tangent there, but as always, we appreciate you guys watching and listening. Give us a like, subscribe, comment, shoot us an email because that's back up and working. And we'll look forward to seeing you guys next week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.